Hi, welcome to lesson number 5 of the Modeliks Financial Planning Masterclass. Today, we talk about forecasting operating expenses. Now, let's dive right into it. So, what are operating expenses? Operating expenses refer to the money spent on goods and services to support your company's operations. In simple terms, common expenses include things like rent, utilities, marketing and sales expenses, insurance, office supplies, and so on. How do we forecast expenses for our financial plan or for our business? There are three main methods for forecasting expenses. Method number one, just enter an expense value. And I will go into more detail on each one of these. Method number two, percent of revenue. And method number three, a driver-based forecast for our expenses. So let's go one by one. Enter your expense value. This is the simplest way of forecasting your expenses, and it's most suitable when we know exactly how much you will spend on a specific expense. A good example is rent. If we pay $1,000 of rent per month, then we just input that amount, and we know that this amount doesn't change. It's fixed over time. Method number two, percent of revenue forecasting. Now, percent of revenue forecasting is most suitable when the expense is directly proportional to the revenue that we generate in our business. A good example would be payment processing fees. Let's imagine we are a SaaS company that we sell we sell software services online, and for all our clients we have a payment processor who processes their payments and collects the cash in our name from our clients. We would have to pay a percent of our revenue as a cost to this payment processing service. So the best way to calculate the payment processing fees would be to multiply the revenues that we generate by the expense for payment processing fees. Now, method number three for forecasting expenses is the driver-based forecast. And the driver-based forecast is best suitable for growing companies and is best suitable in situations where the costs are not fixed and they're not directly proportional with the revenue, but they actually depend on some other driver or another variable which influences that expense, which has the highest influence on that expense. So let's go through an example. Let's say we stick that with the fact that we are a SaaS online company. We sell software services online, or software licenses. So we want to calculate our marketing expense, our Google Ads expense, how much we can expect to spend on Google Ads. Now, to calculate the Google Ads marketing expense, we would use two specific variables or drivers. Number one is the number of visitors that we get through Google Ads to our website, and this will be basically ad clicks to our ad, and we will multiply the number of clicks or the number of visitors with the cost per click. Now, every time a user clicks on our ad that we have posted on Google, that user will be forwarded to our website. He will become a visitor, and we will pay to Google a certain amount of money for that visitor or for that click. But now we should go deeper and define and calculate the number of visitors that we can expect based on two different drivers or two different variables, and those are the number of leads divided by a conversion rate from a visitor into a lead. Let's imagine that we have a 15-day free trial for our software so that our potential customers can try the product before they subscribe. So everyone that subscribes to our free trial would be considered a lead. So the number of leads or the number of free trial users that we have divided by a conversion rate from a visitor into a lead would give us the total number of visitors that we need in order to have the amount of leads that we expect, or the number of free trials. Then let's go one step deeper and define or calculate the number of leads that we will need based on two different variables, two different drivers. And these are the number of clients that we expect the number of new clients that we expect to acquire for a certain period of time, divided by the conversion rate from a lead into a client. And based on these two variables, we can calculate, based on expected new clients and the conversion rate, we can calculate the number of leads. So When you build your expense forecast based on these logical drivers, what happens is that it allows you, this forecast will allow you to actually manage your business better and to understand where you can improve your business and in order to become profitable. What where are you what are you doing well, and where is the room for improvement? So from this example, what you can see is there are several variables that we can see whether we need to improve or not. There is a cost per click. Let's say we're paying $5 per click to Google. If we compare this number to market benchmarks, we will know whether we are overpaying or our cost per click is good enough. So we can see whether we're doing a good job on the cost per click side. On the side of the number of visitors, number of leads, number of clients, we look at the conversion rate. So a conversion rate from a lead to a client or from a free trial into a client. Let's say that 50% of our free trial users, our leads, convert into clients. Amazing. That means that our product is great. Whenever people try the product, they love the product and they convert, half of them convert into clients. So we're doing a great job there. Not much room for improvement. We're happy there. But let's say that our conversion rate from a visitor to the website to a lead is only 0.5%. For every 200 people that come to our website from these expensive clicks from Google, only from 200 people that come, only one actually subscribes to the free trial. Here we see that we have a problem. Our conversion rate from a visitor into a lead is too low, so we need to understand why is that and improve that conversion rate. Probably two reasons: because we are either not bringing the right people that are interested in this type of product from the Google ads, which means we need to change the targeting of the ad, or our website, the way that we communicate the features and the benefits of our product is not good enough for people to actually try to buy the product. So you see, when you build a driver-based forecast, it allows you to properly manage your business and run scenarios to understand if you improve some metrics, some driver, what will the impact be on your business. So that's it. Those are three operating expenses forecasting methods. Now, let's talk about defining the assumptions. Now we've decided how we are going to forecast our expenses, and let's say we decided we're going to do it based on a driver-based forecast for our Google Ads expense. But where do we get the cost per click assumption? Where do we get the conversion rate assumptions? Where? Well, there are two specific places. One, historical, financial, and operational data. If your company has been existing, has been working for a while, you have this information from your past, so you can use your past data to forecast your future performance. If you're a new business, then probably the best place to find these assumptions in order to create your financial model and estimate your operating expenses is to look at competitor market benchmarks. How much is the average cost per click for your industry? How much are the average conversion rates from a free trial into from a visitor to a free trial and from a free trial into a customer? Use those competitor and market benchmarks in order to estimate what your marketing expenses would be in this case. Now let's jump into Modeliks and see how expenses forecasting works in Modeliks and how Modeliks makes that process of forecasting super easy. So this is Modeliks. Let's calculate or let's forecast some of our operating expenses for a SaaS business. Let's stick with the same example. We have a SaaS business. So I've created one revenue stream for our SaaS business, which is subscription revenue. And now let's go into expenses up here and forecast few expenses with the different methods that we talked about. Now, let's add expense. So the first expense we're going to add is going to be rent. And rent, when it comes to rent, we always pay it's a fixed amount of rent that we pay every month. We know how much it is. It doesn't change. So we're gonna choose here that we're gonna select the expense function. This is a general and administrative expense. And then under how will you enter this value, the value for this expense? We're gonna say a dollar value. I'm gonna click next, and then all we need to do is just input the amount of rent that we pay. Let's say we pay per month $1,000. We copy paste that per month, and then it calculates per year 12,000. That's it. Click save and close. And now our rent expense for rent expense of $1,000 has been calculated for us. Now, let's add a second expense, which is going to be a payment processing fees. And this is going to be a direct cost as an expense function. Is going to be direct cost because this cost directly depends, is associated with the service that we sell. And how will you enter this value of this expense? This is going to be a percent of total revenue, or a percent of specific revenue stream. But that's, since we have only one revenue stream, this is going to be the same. So percent of total revenue, we click next. And then all we need to do is define what is the percent of revenue that we need to pay to our payment processor for their services. Let's say it's 4% of the revenue. We click this button here, we copy paste that. We don't expect that number to change over time. So 4% every month and year. We click save and close. And with that, we have calculated now our payment processing fees for our software SaaS business. And then let's now calculate our Google expense that we had as an example before. So Google Ads expense. Google Ads expense, this is going to be a sales and marketing expense. And we're going to select that we're going to enter it as a dollar value first. Now, but since we don't want to enter it as a dollar value, but we want to calculate it based on the specific drivers for this cost. As we saw in an example, we're going to click this button here, set formula. Then we're going to say, we're going to first add two variables. First driver, create new. This is going to be number of visitors to our website. And then we create that first variable. Then we create a second variable, which is going to be a cost per click. Now we're going to set the formula for Google Ads expense to be equal to the number of visitors, or the number of clicks to our ads, multiplied by the cost per click. We set that formula. Now we have the Google Ads expense equal to the number of visitors multiplied by the cost per click. Now, we don't want to stay there. We wanted to calculate the number of visitors based on two different variables. So we're going to set a formula for the number of visitors now. And those two variables are going to be, we're going to create a new variable, which is going to be number of leads, or free trials. The number type. We're going to create that variable, and we're going to create a second variable, which is going to be a conversion rate, lead to visitor, or visitor to lead. And this is going to be a percent type of input. We'll create that. Now we'll set the formula that the number of visitors is going to be equal to the number of leads divided by the conversion rate. And since actually the number of leads cannot be a decimal point, we will actually use a round down formula. I'm going to say round down that formula, put it in brackets. Now we'll set this formula. So now the number of visitors is equal to the number of free trials divided by the conversion rate from visitor into a lead. Now we set the number of leads. We want to calculate them with a different formula. Click set formula. And we're going to say now the number of leads, we were going to calculate it as the total number of new customers divided by the conversion rate from a lead into a customer. But when I defined the revenue for our business, I had already defined how many new customers we expect to get. So I'm gonna click here. I'm gonna say add driver, select from existing, and then I'm gonna search for our revenue, which was called subscription revenue. And here I'm gonna see actually signups. Signups from subscription revenue is our new customers. That's an existing driver. I'm going to add a second variable, which is a new one, which is going to be a conversion rate from lead to customer. Lead to customer. And it's going to be a percent. Create that variable. And now my number of leads is going to be equal to the number of signups divided by the conversion rate lead to customer. And again, let's use the round down here formula, because the number of leads cannot be a decimal point number. So we set a formula, set formula. And now the number of signups or the number of new customers is already pulled from the revenue logic. Now we need to define the conversion rate from a lead to a customer. So let's say that from a lead to a customer, we are able to convert 20% of our leads into customers. Okay. Now we've defined that. Now let's go to the visitors tab here. And here we are calculating the number of visitors based on number of leads, which we already calculated before, multiplied by the conversion rate from a visitor into a lead. Let's say we are able to convert 10% of our visitors into leads or free trial users. And let's look at the Google Ads expense. Now we have the total number of visitors calculated that we need. And how much do we pay to Google for every click? Let's say we pay $5. And let's imagine this will not change over time. Now, with those inputs, we have now calculated the total Google Ads expense. And we have calculated in a way that now it is automatically linked to the number of new customers that we get from our revenue side. So if we change anything in our revenue assumptions around the new customers, automatically the Google Ads expense will change. And also, just going to save and close there. And also, we have calculated based on those variables, based on those drivers that have the highest impact on this expense. So here it is, my Google Ad expense. And we are able to see the logic there. Here it is. We have all our assumptions there. So if we want to test, if we want to run scenarios, we want to see what happens if we just change one number. What if you're actually able to improve our conversion rate from lead to customer to 30%? What would that mean in terms of our marketing budget that we'll need? There it is. Automatically, our marketing budget changed to $16,000. Before that, at a 20%, conversion rate, we needed $25,000 budget. So you see, now everything is logically linked. And whenever we change one assumption into our expense, the whole logic updates the total expense for our market expense, our Google Ads. So driver-based financial planning or driver-based expense planning in this case is really by far the most accurate and the most professional way of estimating your expenses when those expenses are not fixed and when those expenses are not directly proportional with the revenue that you generate for your business. That's it. This is how you forecast the expenses in Modeliks. Finally, let's talk about sense checking your assumptions. Now, once you're done forecasting your expenses, or once you're done with your full financial plan for your business, there's one last very important step before you are done, and that is to sense check your forecast. Sense check your expenses forecast, your revenue forecast. Now, how do you sense check your expenses forecast? There are two specific ways, or two ways to do it. One is to compare it to your historical data for your business. If you are an existing business that has been in operations for a few years already, you should compare the assumptions that you have used to calculate to forecast your future expenses with your past performance. You know, if for example in the past you had payment processing fees, let's say they turned out to be 3% of your revenue, and now in your plan you're putting only 1% of revenue. Well, you better have a good reason or good explanation why all of a sudden your payment processing fees are going to be 1% instead of 3% that you had for the last 3 years. The second best way to to sense check your financial plan or your financial projections in case you don't have past data is to compare it to market benchmarks. And this is, for example, let's say you've built your Google Ads expense logic and calculation based on number of visitors they have multiplied by a cost per click. Now, you've said that the cost per click for your business is going to be $0.50. Well, if you look online and if you look at benchmarks for cost per click for different industries, you will probably see that the cost per click on average, at least in the US, is going to be more than $2-3 per click. So if you took an assumption that your cost per click is going to be $0.1, well, you better again have a good reason why your cost per click is going to be so low. Conversion rates, your conversion rate from a free trial into a customer. You look at the market benchmarks, you will see that usually the conversion rate from a lead, from a free trial into a customer is anywhere between, let's say, 5 and 20%. If you took an assumption and you said that your conversion rate is going to be 1%, well, that's too low as an expectation. You should find a way how to at least have a conversion rate that is within the market benchmarks. So that's it. Those are the two ways to sense check your financial forecast, your assumptions that you put in for your financial plan, your historical data, and market and competitor benchmarks. With that, I'm going to end this session. I hope this was helpful when it comes to estimating or forecasting operating expenses for your business. If you liked this session, please subscribe to our channel. And there are many other useful videos like this one on our YouTube channel. So go ahead, have a look, and enjoy. Have a great day.